multi-billion-dollar loan to build out the future of AI would have Wall Street's biggest banks just fighting tooth and nail for a piece of the axe.
Oh, absolutely. You'd think they'd be all over it.
Right. But today we're going to talk about why they walked away and, who is stepping in to write that massive check instead. Welcome to Market Recap. I'm Daniel.
And I'm Mira.
Before we really jump into the numbers, a quick reminder for you. This deep dive is strictly for market context and discussion. It is not personal investment advice or, an investment recommendation.
Definitely. It's just content.
Okay, so let's unpack the incredibly volatile round-trip action we saw today, Friday, August 24, 2026. Because if you were watching the opening bell, you saw the floor completely fall.
It was ugly. Just a sharp drop right out of the gate.
Yeah, but by the close, both the S&P 500 and the NASDAQ staged this massive recovery. They each finished up exactly 0.43%.
They did. But, if you look under the hood of those equity benchmarks, the safety trades were absolutely screaming all day.
Oh, yeah.
Gold, for instance. Right, gold just rocketed to a historic high. It closed at $4,662.20 an ounce. And in the bond market, the 10-year Treasury yield just marched relentlessly higher, ending the day at 4.738%.
Which is huge. It was a day where the surface looked calm by 4 p.m., but the underlying currents were just violently shifting around.
It really is a fascinating split screen.
So here is our roadmap for you today. We are going to unpack the overnight diplomatic maneuvers in the Middle East that completely reset the geopolitical table.
Yeah, some big shifts there.
For sure. Then we'll dive into the U.S. trading session, breaking down some seriously mixed economic data and that massive AI power play we mentioned at the top.
And finally, we'll cover the late-day political remarks from Washington and roll right into our live paper trading session to see how we're positioning for Monday.
Perfect. So session one, what set the stage before the U.S. session?
Well, to understand Friday morning, you really have to rewind slightly to the carryover context from Thursday, August 20th.
Right, because we came into today with this incredibly heavy geopolitical overhang.
Exactly. Washington had just announced that maximum economic pressure campaign against Iran. And oil markets were functioning with a massive geopolitical risk premium. Following those tanker seizures in the Gulf of Aden.
But then overnight, the diplomatic back channels just kind of lit up.
They did. The Omani and Iranian foreign ministers held a direct call to discuss conditions for resuming safe commercial shipping through the Strait of Hormuz.
And shortly after that call, we got a highly specific physical market signal. Saudi Aramco suddenly asked its LPG, that's liquefied petroleum gas buyers, to load their cargoes from inside the Persian Gulf.
Which is an incredible operational shift, if you think about it. For the first time since regional infrastructure took a hit back in February, Aramco is signaling enough confidence in local security to load from the inside.
Rather than piping it out to safer waters first,
Yeah,
right?
It's a very localized de-escalation signal.
But wait, let me challenge that reflex we all have for a second. The market always seems to treat these geopolitical flare-ups like unpredictable natural disasters.
Like a hurricane or something.
Yeah, exactly. Like a hurricane that just spins up, wreaks havoc, and dissipates. But if we view this through the lens of geopolitical escalation as game theory brinkmanship, it totally changes the picture.
It really does. You have to ask, are these naval warnings and subsequent diplomatic back channels just, calculated moves?
Right. It feels like both sides are just turning the dial to extract maximum leverage without actually triggering a regional war.
That is the core of the brinkmanship strategy. It's about controlling the temperature, not burning the house down entirely.
Because Iran needs the leverage of threatening the strait.
Yes, which normalizes a fifth of global oil transit. But a closed strait also chokes off their own remaining economic lifelines.
Exactly. So the overnight diplomacy stabilized the pre-market specifically because it showed the game theory was working. The players found the edge, and then they started talking.
Spot on. But while that was happening in energy, the pre-market tech sector was dealing with a totally different kind of whiplash.
Oh, man. Tesla.
Yeah, at 6:16 a.m. Eastern Time, Tesla delivered the ultimate split personality morning. On one hand, China's market regulator announced a massive recall of nearly 3 million Tesla vehicles over emergency door release issues.
That is just a brutal, physical, operational headache in their most critical global growth market.
It is. But in the exact same breath, They scored a massive regulatory win stateside. Nevada officially cleared Tesla to operate up to 5,000 autonomous robotaxis in Clark County.
So you have a hardware nightmare in Asia and a long-term software valuation dream coming true in the U.S. desert, all hitting the tape before breakfast.
It perfectly encapsulates the dual narrative of the market right now. You have the immediate physical friction of manufacturing versus the long-term technological promise of software.
Yeah. And while that overnight diplomacy provided a temporary stabilizing backdrop, reality just hit hard the moment the sun came up. Which brings us to our next segment.
Session 2. What moved markets during U.S. trading hours?
And what a chaotic open it was. The U.S. cash market went live, and the bottom immediately dropped out.
The S&P 500 dipped all the way down to 7,661.25.
And the NASDAQ plunged to 29,303.50.
Yeah, the trigger for that initial drop was macroeconomic data. Specifically, the 9:45 a.m. Eastern Time S&P Global Flash PMI release.
It painted a picture of a severely two-speed economy, didn't it?
It really did.
Yeah.
Let's break those numbers down, because if you're looking at your portfolio wondering why it just took a hit, this report is the culprit.
Right. The services PMI unexpectedly jumped to 56.8. Now remember, with PMI data, 50 is the baseline.
Right. Anything above 50 means the sector is expanding.
Exactly. And below 50 means it's contracting. So 56.8 in services is incredibly hot. But the manufacturing PMI missed expectations, coming in at 53.2.
Navigating this kind of data is less like steering a cargo ship and more like driving a car, where the steering wheel of the Federal Reserve is increasingly disconnected from the tires.
The actual economy, yeah.
Exactly. You have a resilient consumer services sector. People are still going out, traveling, spending on experiences. But services are highly labor-intensive.
And when demand for labor stays high, wages stay sticky. When wages stay sticky, inflation stays sticky.
Which is a classic problem.
Right. It's a textbook case of good news is bad news for rate cuts. If you were hoping the Fed was going to bail out the market with aggressive easing, a hot services PMI complicates that path severely.
It really does. The bond market instantly priced out some of those aggressive rate cut expectations. That's why we saw the 10-year Treasury yield spike to 4.738%.
We have to remember the concept of the discount rate as gravity.
Yes, that is crucial here.
When that 10-year yield goes up, gravity increases on equity valuations, especially for those high multiple tech stocks. Their future earnings are mathematically worth less in today's dollars when the risk-free rate is high.
But that gravity didn't hold the NASDAQ down all day.
No, it didn't.
The tech sector violently ripped back into the green, driven by a major infrastructure announcement. At 8:31 a.m. Eastern Time, NVIDIA announced a strategic partnership with Cloverleaf Infrastructure to build gigawatt-scale AI factories right here in the U.S.
A gigawatt is a staggering amount of power. I mean, it's roughly the output of a standard nuclear reactor.
We've talked extensively about AI power demand as a physical grid bottleneck before.
Yeah.
NVIDIA partnering directly with infrastructure developers shows they realize they can't just sell silicon anymore. They essentially have to help build the power plants to turn those chips on.
Wait, so you're telling me we can design a chip that mathematically mimics human logic, but we literally don't have the copper in the power lines to plug it in?
Basically, yeah.
That seems like a massive misallocation of capital by the broader market. We've treated AI CapEx as a self-referential valuation loop for so long.
Big tech buys chips, NVIDIA's valuation pumps, justifying more spending.
Right. But that loop is finally hitting a very physical wall.
It's hitting a physical wall, and a financial one, too. Which brings us to the capital required to build this out. Think back to the carryover context from Thursday afternoon at 4:09 p.m. ET.
Oh, the Broadcom news.
Yeah. Broadcom is out in the market seeking over $60 billion in debt financing, specifically for AI chips and infrastructure.
$60 billion. I mean, to put that in perspective, if you want a loan that big, you usually go to a massive traditional bank.
Right.
The bank underwrites a syndicated loan, which basically means they chop that $60 billion up into smaller pieces and sell the risk off to dozens of other banks.
But regulatory limits on concentrated risk mean traditional banks simply cannot or, will not stomach a loan of that size for a single tech build-out.
They are walking away from the table entirely. And that's why we are seeing private credit giants like Blackstone and Apollo heavily involved in these talks.
Private credit has just become this flexible capital release valve. They aren't bound by the same syndicated banking regulations, so they can step in where traditional financing taps out.
The tension here is just palpable. You have early rate jitters pulling the market down, but the sheer size of this private AI infrastructure spending combined with a massive safe haven bid in gold just overpowered the gravity.
It really carried the session higher.
It is a market that absolutely refuses to quit on the AI thesis. But while tech and bonds were battling it out, we had some significant late-day political and trade developments that are going to deeply impact industrial margins. So let's shift gears.
Session 3, corporate events recap and what to watch next.
Right. So starting Friday morning at 9:01 a.m. ET, active U.S.-Canada trade negotiations were taking place.
Reports indicate that these talks are moving much closer to introducing a strict steel quota system.
Let's explain why this matters. You know, if you hold U.S. industrials, auto manufacturers, or construction firms, a tariff is a tax, but a quota is a hard physical cap on volume.
Very different mechanics.
Exactly. If you cap Canadian steel imports, U.S. steel producers suddenly face far less competition. So what do? They raise their domestic prices.
And if you're building tractors or cars, your raw material costs just skyrocketed overnight. And you can't necessarily raise the price of your product by 10% tomorrow.
No, you can't. It is a classic margin squeeze hiding inside a trade victory.
It's the mechanics of supply chains catching up to policy. And speaking of policy, we had major macroeconomic commentary from the top. At 4:54 p.m. ET, President Trump spoke to reporters at Joint Base Andrews.
Yeah, he explicitly denied rumors that he was directing Treasury Secretary Bessent to intervene in the bond markets to artificially lower yields.
He also made a very bold fiscal claim, stating that, quote, growth will take care of the national debt.
He added that the U.S. retains total control over the Middle East dynamics, too.
I mean, the math on that fiscal explanation is incredibly neat. But if you look at the underlying mechanics, it's a mathematical mountain.
Right. Can economic growth realistically outpace the sheer gravity of a $40 trillion debt burden?
Especially when you factor in the heavy Treasury supply that investors are currently choking on to fund current deficits.
It requires a sustained level of GDP growth that we just haven't seen in decades. And ironically, that level of red-hot growth would likely trigger the exact sticky inflation the Fed is currently trying to crush.
Which just sends yield higher anyway, to sneak eating its own tail.
Which brings us to the moment you've been waiting for at the close.
After today's volatile round trip, you can finally breathe a sigh of relief, unless you're on the hook for the electric bill on NVIDIA's new gigawatt-scale AI factories.
Between Broadcom shopping for a cool $60 billion in AI debt and Gold Rocket launching to historic highs near $4,662, it seems the only thing growing faster than tech valuations is the price of actual shiny metal.
Even Tesla had a split day, recalling nearly 3 million cars in China while getting autonomous clearance in Nevada. So if your Model Y drives off without you this weekend, it's probably just running away from its own recall.
But with President Trump reassuring us today that growth will take care of the debt, I'll be sure to pass that exact wisdom along to my credit card company.
Have a great weekend, and may your portfolio stay as golden as today's commodity close.
Awesome. But before we officially head into the weekend, here is what you need to watch next.
On Sunday at 6 p.m. ET, the futures markets reopen. You need to monitor any weekend developments in those U.S.-Iran and Oman Strait of Hormuz shipping negotiations.
That binary event will really set the tone for energy.
On Monday at 8:30 a.m. ET, we get the Chicago Fed National Activity Index.
Then at 11:30 a.m. ET, keep a close eye on the U.S. Treasury 13-week and 26-week bill auctions. We really need to see if the market can digest this debt without demanding even higher yields.
And finally, from Monday pre-market through the close, watch for the repricing of AI capex and private credit leverage following that $60 billion Broadcom financing report.
Yeah, credit markets digesting that kind of size will have ripple effects across the entire tech sector.